On February 22, 2025, Warren Buffett released his annual letter to Berkshire Hathaway shareholders. That letter contained one sentence that no Berkshire shareholder letter has contained in the 56-year history of his stewardship of the company. "We have $334 billion in cash and U.S. Treasury bills." One sentence. And in that one sentence, three things became simultaneously true that have never been simultaneously true in any prior Berkshire Hathaway annual letter. First, Berkshire's cash position exceeded the gross domestic product of Denmark, Finland, and Portugal combined. At $334 billion, the cash that the most successful investor in the history of American capitalism is holding in reserve is larger than the entire annual economic output of 170 of the world's 195 nations. Second, that cash position was built during a period when Buffett was simultaneously a net seller every single quarter for 7 consecutive quarters. He was not holding cash because he ran out of things to buy. He was holding cash because he made a specific decision to sell what he owned and refused to replace it. Third, the $334 billion lands precisely 65 days before the most consequential 72-hour window in American financial history since March 2020. On April 29, 2026, Jerome Powell chairs his final Federal Open Market Committee meeting. That same afternoon, Microsoft, Alphabet, Meta, and Amazon report earnings. The following morning, the Bureau of Economic Analysis releases the first estimate of Q1 2026 GDP. And on May 3, 2026, Warren Buffett sits down before 40,000 shareholders in Omaha, Nebraska, with $334 billion in cash, and answers questions about what he knows that the market does not. This is not a coincidence of timing. This is the signal. Let me build precisely what makes this the most important cash position in the history of American investing, and why the specific timing of Buffett's annual meeting on May 3rd, 1 week after the most data-dense 72 hours in the 2026 financial calendar, is the piece of information every institutional investor has been quietly positioning around for the past month. Start with the number itself, $334 billion. To understand what that number means, you have to understand what it is not. It is not the amount Berkshire holds, because Buffett could not find anything to buy. Berkshire generated $47.4 billion in operating earnings in 2025. He had the cash flow to act. He chose not to. It is not the amount Berkshire holds because he is bullish on Treasury yields. Buffett has been explicit in prior letters that he does not hold cash to speculate on interest rate movements. He holds cash as what he calls ammunition. The word is deliberate. Ammunition is not stored because you intend to hold it indefinitely. Ammunition is stored because you intend to fire it. The question is not whether Buffett intends to deploy the $334 billion. The question is what target he is waiting for. And it is not the largest cash position in Berkshire history because nothing happened in 2025 to cause him to sell. Buffett was a net seller in every quarter of 2024 and 2025. He reduced his Apple position from 5.6% of Apple's outstanding shares to approximately 2.3%. He reduced his Bank of America position. He eliminated positions entirely. He did not reduce these positions because the companies became bad businesses. He reduced them because his assessment of the price he was being offered for them exceeded his assessment of their intrinsic value. That is Warren Buffett telling you, in the language he has used for 56 years, that the market is overpriced. Now apply the 3 historical precedents. Because the $334 billion cash position is not the first time Buffett has built a cash reserve of this relative magnitude before a significant market event. Understanding the prior 3 instances reveals the specific mechanism through which the May 3rd annual meeting becomes the most important financial event of the first half of 2026. Precedent 1. The dot-com peak, 1999 to 2000. In 1999, Warren Buffett was publicly criticized by the financial press for his refusal to invest in technology companies. Berkshire's stock underperformed the S&P 500 by 41 percentage points in 1999. Fortune magazine published an article titled, "What is Wrong with Warren?" His cash position was building. He continued to refuse to deploy it into the assets that the market consensus said were the obvious investments of the era. The Nasdaq peaked in March 2000. Over the following 30 months, it lost 78% of its value. Buffett did not participate in the crash because he had not participated in the bubble. His cash position was not a mistake. It was a measurement. His refusal to invest in 1999 was not confusion about the new economy. It was a precise and ultimately correct valuation conclusion that the Prices he was being offered for assets were not justified by any sustainable earnings projection. The lesson from 1999 is not that Buffett got lucky, it is that the magnitude of his underperformance in the year before a crash was the specific signal that he had made a valuation judgment the market consensus had not yet absorbed. In 2025, Berkshire underperformed the S&P 500 while building cash at a rate that implies an identical valuation judgment. The S&P 500 is currently priced at a cyclically adjusted price-to-earnings ratio of 34.2. The only prior periods when that ratio was higher were 1929 and 2000. Precedent 2. The 2008 financial crisis. In October 2008, as Lehman Brothers had collapsed, AIG had been nationalized, and the S&P 500 was in freefall. Warren Buffett published an op-ed in the New York Times titled, "Buy American, I Am." At the time of publication, Berkshire was deploying billions into Goldman Sachs, General Electric, and other distressed assets at prices that reflected genuine panic rather than genuine insolvency. What most coverage of that op-ed missed was the specific mechanism. Buffett was not buying because he thought the bottom had been reached. He was buying because the prices he was being offered provided a sufficient margin of safety regardless of how much further the market declined. He had been building cash for years before 2008 precisely so that when prices reached that level of distress, he had the ammunition to act. The lesson from 2008 is about the specific advantage of cash in a falling market. Every dollar of cash becomes more powerful as asset prices decline. A 30% market decline does not reduce the purchasing power of cash. It increases the amount of equity that cash can purchase. Buffett's $334 billion deployed into a market that has declined 20% purchases the same amount of assets that $418 billion would purchase today. He is not waiting to deploy the $334 billion at today's prices. He is waiting to deploy it at different prices. The question every investor should be asking before the May 3rd annual meeting is what price level he is waiting for. Precedent 3. March 2020. On February 21st, 2020, the S&P 500 began its COVID-19 decline from an all-time high. Over the following 33 days, it lost 34% of its value in the fastest bear market in recorded history. Buffett did not deploy his cash during that decline. He had the ammunition. He chose not to fire it. He explained why afterward. The decline, while severe, resolved too quickly. The Federal Reserve's March 15th emergency rate cut to zero, and the subsequent $4 trillion in quantitative easing compressed the correction window to 33 days. Assets that had traded at distressed prices on March 23rd were trading at pre-crisis prices by August 2020. The recovery was too fast for traditional value investing to work. After March 2020, Buffett said publicly that he did not see anything attractive to buy at the prices available in the crisis. The market had not gotten cheap enough, long enough for him to act. Apply those three precedents to the specific question of May 3rd, 2026. Warren Buffett is sitting on $334 billion. He has just watched the Federal Reserve Chair for the past 8 years leave office. He is watching his successor take control with an explicit political mandate to cut interest rates. He is watching oil trade above $100 because a war in the Middle East has disrupted the most critical maritime shipping lane on Earth. He is watching the S&P 500 trade at valuations that have only been exceeded twice in 100 years. And in 7 days, he is going to sit in front of 40,000 shareholders and answer questions directly and in plain English. Buffett does not issue press releases. He does not speak through spokespeople. He answers, in the language he has used for 56 years, what he thinks about prices, about the economy, and about what he is seeing inside the specific businesses Berkshire owns. Businesses that give him real-time data on the American consumer through Geico, on American energy through Berkshire Hathaway Energy, on American freight through BNSF Railroad, and on the American insurance market through General Re. Data that no quarterly GDP report captures, data that no Fed statement reflects, data that no earnings call from a technology company reveals about the physical economy. Now, here are the 3 false narratives about the Buffett cash position that most financial media coverage has failed to address. The first false narrative is that $334 billion represents a problem of scale, that Berkshire has simply grown too large to deploy capital efficiently, and the cash is an artifact of Buffett's inability to find deals large enough for a company of Berkshire's size. This narrative fails for one specific reason. Berkshire made $11.6 billion in Acquisitions in 2023 alone. It has the demonstrated capacity to deploy capital at scale when the prices justify it. The cash accumulation in 2024 and 2025 was not the result of a shortage of opportunities. It was the result of a specific valuation judgment that the prices available in the market did not meet Buffett's threshold. He could have bought. He decided not to. That decision is the signal. The second false narrative is that Buffett's cash position is irrelevant to individual investors because Berkshire operates at a different scale than any retail portfolio. This narrative confuses the operational value of the cash with its signal value. The $334 billion is not relevant because you can replicate it. It is relevant because it represents a specific and historically successful investor's conclusion about the current price level of assets in the American market. When the most successful value investor in history is holding 29% of his total assets in cash at a moment when the S&P 500 is at an all-time high, the signal is not about scale, it is about valuation. The third false narrative is that the May 3rd annual meeting is primarily a sentimental occasion, a generational passing of the torch at one of America's most storied companies. It is the opposite. May 3rd, 2026 is the first public forum after the most data-dense 72 hours in the 2026 financial calendar, where the single most successful investor alive will speak unrehearsed about what he observed. He will have Jerome Powell's final press conference transcript. He will have Microsoft, Alphabet, Meta, Amazon, and Apple's full earnings reports and forward guidance. He will have the Q1 2026 GDP advance estimate and the March PCE inflation data. And unlike every analyst, economist, and financial commentator who will be processing that same data, Buffett will be processing it with 56 years of pattern recognition and $334 billion in deployment capacity behind him. The May 3rd annual meeting is not a ceremony. It is the most information-dense financial event of the first half of 2026. And the question it answers is binary. Will the man holding $334 billion in cash tell you he is about to deploy it, or will he tell you he is still waiting? Here is the specific arithmetic of the next 10 days. On April 28th, the Federal Open Market Committee begins its two-day meeting. Jerome Powell chairs for the last time. On April 29th, the FOMC releases its policy statement at 2:00 p.m. Eastern. Powell's press conference begins at 2:30 p.m. That evening, Microsoft, Alphabet, Meta, and Amazon report earnings. The four companies reporting that evening represent approximately 22% of the S&P 500 by market capitalization. Their forward guidance for the second half of 2026 will determine whether the consensus earnings growth projection of 11% remains intact. On April 30th at 8:30 a.m. Eastern, the Bureau of Economic Analysis releases its first estimate of Q1 2026 GDP, simultaneously with the March Personal Consumption Expenditures Price Index, the Federal Reserve's preferred inflation measure. Continuum Economics projects core PCE at 4.1% annualized. If that projection proves accurate, it will be the stickiest inflation reading in 6 quarters and will complicate every assumption about the rate cuts the S&P 500 at an all-time high is currently pricing. Apple reports Thursday evening. Apple's commentary on consumer spending in China and its services revenue trajectory will be the final major data input before the weekend. On May 3rd, Warren Buffett walks onto the stage in Omaha with $334 billion. In the 96 hours between Powell's final press conference and Buffett's first answer in Omaha, every asset class in the global financial system will be repriced. Treasury yields will move on the Fed statement language and the GDP and PCE prints. Equity multiples will move on the Magnificent Seven guidance and the GDP trajectory. Gold will move on the PCE inflation signal. Oil will move on whether the Iran ceasefire negotiations produce any progress while the FOMC is in session. And every institutional portfolio manager who has spent the past month positioning around this sequence will be watching Buffett on May 3rd to understand whether the most successful capital allocator in history reads the outputs of that 72-hour window as a buying opportunity or as the confirmation of a risk he has been hedging against with $334 billion in cash for the past 18 months. Three things will be simultaneously true when Buffett walks onto that stage. He will know what Powell said in his final press conference about the inflation trajectory and the path of rate cuts in the second half of 2026. He will know what the four largest technology companies by market capitalization said about their earnings and forward guidance in the same 24-hour window. He will know whether Q1 2026 GDP confirmed the soft landing the market is pricing or delivered the stagflation warning that Jamie Dimon described in his April 6th shareholder letter as the specific risk that could send the S&P 500 towards 6,000. The $334 billion is either about to be deployed or it is about to grow. Those are the only two outcomes. And at 9 a.m. on May 3rd, 2026, the answer